Good evening. Yesterday, I was deliberating with my friend on some international index in a foreign currency where we were deliberating about our trading style and trust that this discussion hasn't happened for more than 40 minutes. Every day around 30 minutes, I deliberate on some or other international topic with my friends. Because I strongly believe that if you share your knowledge, then your knowledge will grow. On the contrary, if you do not share your knowledge, keep it with yourself, then your knowledge would never grow. Now, in this debate, a very handsome point came on the table, and that handsome point was very important point. Handsome point was whether a person should be a FNO trader or he should be a cash trader. And my apparent answer is that he should be a cash trader rather he should be a FNO trader. Now, before I proceed, let me make one thing very clear that this should not be linked with any relevant index. Say so and so. Of any relevant company, so and so, or relevant country, say so and so. Because if you are linking this concept, then you are linking at your own risk because I am deliberating about a concept. Technically speaking, the global indices are offering four things. One is called index options, one is called index futures, one is called stock options, one is called stock futures. While United States, which is a global financial center, is also offering, which is called VIX. VIX is called Volatility Index. On the contrary, there is another instrument which is called VVIX, which means volatility of volatility. Like you are having beta, then you are having gamma, which means beta over beta, right? Similarly, you are having VVIX, volatility of volatility. And that is a very interesting concept. Anyways, so my viewpoint to my friend is, and that's why we together decided to make a video on this. I said you should not play in future and options for multiple reasons. Number one, future and options are having limited tenure. Like some countries are having 1 month, some countries are having 2 months, and some countries having 4 months, some countries max to max 5 months, which means that if today I am buying a future of so and so index, and suppose the maximum periodicity which is offered to me is 2 months, which means that if within 2 months the index is not going the way I'm expecting, it means I'm losing. Max, what I can do? Max, I roll over the future, but point is how long. So, example that a index is traded at 40,000, and I thinking that it is going to 42,000 because of the bullishness in the index. So, what I did, I bought a future contract. When I buying a future contract on an index, it means that I'm expecting that it will go to 42,000 or maybe 43, whatever presumption of mine. And suppose it went to 36 and the maximum duration the index is offering me is 2 months, which precisely means if within 2 months, if at the end of 2 months, the index is at 36 and I bought at 40, it means I'm losing. Max, I would roll over. When I roll over, I end up losing the difference, which is 40,000 minus 36,000. Like if I strictly speak in the parlance of United States, behind a move of a single dollar in an index, it is around $100, which means the difference is 4,000, which means 40,000 minus 36,000, 4,000 into $100, which means 400,000, which is near to $500,000 is my loss I am taking in my books. The max I could do, I could create create a rollover. But I'm not sure because if I'm creating a rollover, maybe from 36, it will further slide to 33. Because we know that there are ample of news which is coming up in the public. Like now there is a news that Chinese government is coming up with a very big rescue package for the economy. I personally read that news in public. But whether this rescue package which Chinese government is coming up with would be helpful for the Chinese economy, I'm not sure. Whether this would be able to revive the Chinese economy, I'm not sure. How soon this package is coming, I'm not sure. Henceforth, only on the title that Chinese economy is coming up with the largest revival package in this eventuality, the stock markets in the Asia slide because they believe that now China would again be back. Now, there is a news which is coming from Russia, which is that the Russian government is planning to increase the defense spending up to 40% of the total budget, which means suppose the total budget is 100 rubles, just to take simple example. The Russian government planning to increase the defense spending up to 40 rubles, which means out of 100, 40 rubles would be on the defense. It means the Russian government it would be doing multiple tie-ups with different governments to export the arms and ammunition or whatever way, which means it's a good news for the defense. But how it would translate in the near future, I do not know how it would translate. Similarly, I strongly believe that when I'm buying a future contract, I am buying a high. Or when I'm selling a future contract, I am selling a high. Having said that, this is plain vanilla. We can create n number of strategies in the future also, which is range forward, seagull, straddle, strangle, ratio spread, back spread. We can create n number of strategies. But the biggest question is how many people even understand that? So let me give a very simple example. Suppose I am that so and so index is at 40,000 and I believe that it will go to 42 or 43 or probably higher. I bought future. Unfortunately, it went to 36. And after 2 months, I left with no option either to roll over or to book the losses. In either cases, I need to book the losses. Suppose I did the rollover and God forbid it went down to 32, which means again there is a losses. How long I would do? My capital is constrained. My capital is not endless capital, just like a big HNI and so on and so forth. So the right strategy is to be a cash trader. And the more right strategy is to create a replication. But when I'm using a word replication, I'm strictly confirming that this is known only to the top traders because this is a very hi-fi technical strategy. Every index of the globe is comprised of few stocks. Some indexes have 30, some have 50, some have 40, some have 25, some have 65, even some holding 75 also. But did you ever thought that suppose there is an index which is holding 40 stocks the index is always 100%, which means each stock is holding 100 divided by 40, which is 2.5%. Majority of the indexes are known as like the top 7 or 8 stocks are holding not less than 50, 55, or sometimes 65% of the relevant index. Which means if I'm able to move the top 8, then I'm able to move the relevant index. So on paper, it looks like that index is going up, the economy is going up, the market is going up, but the reality is nothing of that sort is happening because it is the top 5 and 6 which is going up. We all know that every index comprised of large caps, mid caps, small caps, and I titled upper mid caps. Now, the movement of a large cap define an index. If the large caps are going up, the index is going up. But that doesn't mean that if the large cap is going up, the mid cap is going up, the small cap is going up. Now, replication means that the top 5 to 6 stocks which I'm holding, so and so, I'm going to be buying these stocks in a proportionate to the future contract. Now, suppose because every stock having a different lot structure, like sometimes one stock may have 2,000, one stock may have 1,000, one may have 500, one may have 3,000. Now, suppose the 6 stocks contributed 70% of the index. And out of these 6 stocks, what I do, I'm going to be buying all the 6 with ratio of the future. Of course, when I'm using this is not the cup of tea for a retail investor in any country because this involves a huge money. Now, if the index comes down, the value of your stocks come down. But this is a notional loss. This is not a real loss. Why it is not a real loss? Because you bought in cash. It's a notional loss. I own 1 kg of gold, hypothetically, and suppose the price is 2,600. And suppose tomorrow Federal Reserve hike by 100 basis point. All hypothetical example. And gold price, which is at 2,600, went down to 2,500, which means that I lost $100 per ounce. But that's a notional loss. That is a notional loss because I do not have any intent to sell my gold. I have no intent to sell my gold because I am going to be selling once I see my gold at 5,000. Henceforth, the short-term movement makes no difference to me. Similarly, rather than buying an index future, I strongly believe that one should create a replication because when you create a replication and God forbid, due to any geopolitical issue outside that country, due to any geopolitical issue within that country, due to any other X factor in the global economy, if the index falls, you end up being a notional loss person. And if you're a smart investor, a knowledgeable investor, and you link the replication with the option strategies like, straddle, strangle, seagull, range forward, backspread, ratio backspread, cover backspread, inverse backspread. This is very long. Then even if market is going up or market is going down, you would be winning the show. I repeat, you would be winning the show. But there is a very important thing which we need to understand. A very important thing which we need to understand, and that we need to know that when I am doing this strategy, then number one, I need to have a strong knowledge base, which is rare. Number two, my capital is extremely high, which is not the case with majority of the people. And number three, I understand what do you mean by the beta and what do you mean by the impact of beta on this. Suppose out of the 6 stocks of that so-and-so index which I'm talking, 3 stocks are holding a beta of more than 3. What is the meaning of that? It means if the market fell by 1%, God forbid, these 3 would fall by 3%. Or take it other way, if the market increased by 1%, these 3 would increase by 3%. Which means I am creating a structure which is subject to volatility. Which means if volatility grew for a minute, I'm also going up or going down in a substantial manner. Ladies and gentlemen, we need to understand that in a portfolio, there is a thing called beta. And in a portfolio, there is a thing called average beta. And one is called weighted average beta. 99% people do not even understand what do you mean by beta and how beta is impacting your portfolio. Sometimes the index is going up, and what we do, we buy a high beta stock. Till the time index going up, we are happy. The day index falling, we are crying because we bought a high beta stock. On the contrary, if we buy a low beta stock, there may be a probability that we might end up gaining less money, but we always end up losing less money because the beta is low until otherwise something is coming, like any information is coming which is not known to the public. I once again strongly feel that whether it is index futures or stock futures, similarly for the stock future also, right? Rather than buying a stock future, whereby the maximum period for holding is 2 months, and God forbid my projection is not coming true in the 2 months, it takes more than 2 months, I definitely end up losing. And max again, the rollover. And the rollover is subject to your capital because your capital is not unlimited in nature. So, what max you could do the rollover, right? So protect that. It is better I take a cash position. Example, I am buying the largest automobile company of the globe and I'm buying a future contract, say so and so, largest automobile company of that relevant country, say so and so. Now, suppose this so and so country market falls by 10% and the largest automobile player of that country stock is also falling by 15% because the beta is 1.5, which means if the market goes 10%, you will fall 15%. And I bought a future of this largest automobile company. Now what to do? Now what to do? It means I'm losing because I bought a future concept. What would if rather than buying a future contract, I would buy the stocks which are equivalent to a future contract and wait till the time I'm making the profit. So suppose the one lot is equals to 10,000 shares. Just take a simple example, and that 10,000 share is costing 100,000 US dollars. Now, rather than taking a future, I would be investing equivalent to the number of stocks, say 10,000 stocks, and investing 100,000 cash position, even if the market falls by 10% and I would be falling by 15%. I'll wait. I'll wait till the time I'm not making my desired profit. The day I make my desired profit, I quit and look for another opportunity. I strongly believe that cash positioning is a better tool when it comes to futures. But once again, the alternate opinions are most welcome, and I'm ready to argue on the counter opinions also in a very healthy and debatable manner. And also, I strongly believe that when it comes to future, the payoffs also matter. But unfortunately, when it comes to payoffs, we need to understand that for payoff, we need to have a requisite knowledge in place. Just think about that. So, good evening, ladies and gentlemen. This is not the end of the show. We may have hundred of structures. If the time would permit, I would discuss. But if time do not, then it is hard to say about that. But this is Rahul Magan. You have my contact details, the WhatsApp number which is coming, or 9899242978. Good evening. It's Pledge speaking.